The secret to making money in the market is learning when not to make money. I'll say it again because it sounds wrong. The path to wealth is paved with deliberate inaction. You've been lied to. You've been told that the successful speculator is always in the game, always hunting, always moving. That's how brokers think. That's how gamblers think. I'm neither. I wait. I watch. I do nothing while others exhaust themselves. And when the moment is right, when the market itself confirms what I suspected, I move with the full weight of my capital and conviction. That's the rule. That's the edge. And no one wants to hear it because it doesn't sound exciting. But I'm not here to excite you. I'm here to teach you how to survive and profit in a game that destroys most people who play it. And if you can't learn to sit still, if you can't master the art of doing absolutely nothing when nothing is the right move, then you're going to lose. Not sometimes, not maybe. You will lose. The market will take everything you give it, and it will do it without mercy, without apology, and without caring about your reasons or your dreams. Now, let me tell you why you need to hear this. You're exhausted, aren't you? You're tired of trading. You're tired of staring at charts, reading news, trying to time every move. You enter positions and immediately second-guess yourself. You exit too early and watch the stock continue without you. You hold too long and watch profits evaporate. You feel like you're always one step behind, always on the wrong side of the move. And underneath all that frustration, there's a suspicion growing in your mind that maybe the game is rigged. Maybe only the insiders win. Maybe you're just not cut out for this. Let me stop you right there. The market isn't rigged. It's indifferent. It doesn't care about you, your hopes, your bills, or your ego. And that indifference is actually your greatest advantage if you learn to read it properly. The rule I'm going to teach you today isn't about predicting the future. I can't predict the future. No one can. What I can do is wait until the market itself shows me what it's doing. And then, only then, I act with absolute conviction. This isn't a strategy. It's not a system. It's a law of human behavior and price movement that has repeated itself in every market cycle since markets began. And once you understand it, once you really internalize it, you'll never look at trading the same way again. What makes what I'm about to tell you different from everything else you've heard? Most advice focuses on what to buy or when to sell. Tips, picks, technical patterns, fundamental analysis. All of that has its place, sure. But I don't care about any of that if you haven't first mastered your relationship with action and inaction. Can you sit on your hands while your neighbor brags about the gains he's making? Can you do nothing while the financial press screams that you're missing out? Can you wait, truly wait, while everyone around you is in motion? And then, when the moment finally arrives, when the market gives you the signal that it's ready, can you pull the trigger with full commitment while everyone else is frozen with fear? That's what separates the professional from the amateur. That's what separates the man who retires wealthy from the man who blows up his account. It's not intelligence. It's not access to information. It's the ability to control yourself. And that's what this video is about. I'm going to challenge everything you think you know about staying active in the market. I'm going to show you why most of what you've been taught is designed to keep you trading, keep you active, keep you generating commissions for someone else while you slowly bleed your capital away. Let me take you back to the beginning. Early in my career, I met a man in New Orleans who traded cotton. This was decades ago, when I was young and hungry and absolutely convinced that the way to make money was to be in constant motion. I thought trading was a full-time job in the literal sense if you weren't actively making decisions, placing orders, watching the tape every minute. Then you were lazy. You were asleep. You were going to miss the big move. This cotton trader, though, he was different. He was older, already wealthy, and he had this calm about him that I found infuriating. I'd watch him sit in the exchange for hours, literally hours, doing nothing, just watching, just observing. Other men would be shouting, trading, moving in and out of positions, and he'd be sitting there with his arms crossed, quiet as a stone. One day, I couldn't take it anymore. I walked up to him and asked, "How do you make money if you're not trading?" I was genuinely curious, but there was arrogance in my voice. I'll admit it. I thought I had it figured out. I thought constant activity was the answer. He looked at me for a long moment, and I could see he was deciding whether I was worth his time. Finally, he said, "Son, I make money because I'm not trading. Most of these men are feeding the market their capital, one trade at a time. I'm waiting for the market to show me it's ready to feed me. I didn't understand it then. I thought he was making excuses for being scared or for being too old to keep up with the pace. So I ignored him and kept doing what I was doing. I kept trading every setup that looked promising, every rumor that sounded good, every pattern that seemed like it might work. And I made money. Yes, I had wins, but I gave it all back just as fast. I was working hard, incredibly hard, but I was working against myself. I was feeding the market my capital, one trade at a time, just like he said. It took me years to understand what that cotton trader meant. It took several devastating losses, the kind that hollow you out and make you question whether you should even be in this business. And each time I lost big, really big, I'd sit alone afterward and realize that I learned anything new. I'd simply forgotten what I already knew. I'd forgotten that the market doesn't reward activity. It rewards correct activity. And the only way to know if your activity is correct is to wait until the market itself confirms it. Not your hunch, not your analysis, not your gut feeling. The market itself, through price and volume and movement, has to tell you that it's ready. And if you can't wait for that signal, then you're not speculating. You're gambling. Now, let me tell you about another man, because this is important. I watched this man destroy himself in 3 months. He was intelligent, well-funded, and he had a decent understanding of market mechanics. His problem wasn't that he didn't know what he was doing. His problem was that he couldn't stop doing it. He was compulsive. He couldn't sit still. Every dip in the market looked like a buying opportunity. Every rally looked like the start of something bigger. He was always in a position, always leveraged, always convinced that this was the move. This was the one that would make him. I tried to warn him. I really did. I sat him down and said, "You're not giving yourself time to be right. You're just giving the market more chances to prove you wrong." He nodded. He even agreed with me in that moment, but he didn't listen. He couldn't. The need to act had become stronger than the need to win. It was like watching a man with an addiction. The market was his drug, and he needed his fix every single day, sometimes multiple times a day. By the end of those 3 months, he'd churned through his entire account. And here's the tragic part. He didn't lose it all in one catastrophic bet. That almost would have been better in a way, because at least then he could point to a single mistake and learn from it. No, he lost it slowly, steadily, through 100 small trades that bled him dry. The market didn't beat him. His own restlessness did. His inability to do nothing destroyed him. And the real tragedy, the part that haunts me when I think about it, is that if he had simply done nothing for 2 of those 3 months and acted decisively, with full conviction, in the 3rd month when the real opportunity appeared, he would have walked away wealthy. But he couldn't. He was too busy being busy. This is what I mean when I say that most people are trading when they should be waiting. They're in motion when they should be still, and it's killing them. The market will always give you opportunities to lose money. It will present you with dozens of setups every single day that look good enough to trade. But good enough isn't good enough. You need to wait for the setup that is undeniable, the one where the market itself is screaming at you that it's ready to move. And those setups don't come every day. Sometimes they don't come for weeks. But when they do come, that's when you act. That's when you commit. That's when you put real capital to work. Now, let me explain the principle behind all of this, because I need you to understand why this works. The market doesn't care about your opinion. Read that again. The market does not care about your opinion. It doesn't care what you think should happen. It doesn't care about your analysis or your research or your conviction. The only thing that matters is what is actually happening. And there's a big difference between what you think will happen and what the market shows you is happening. Most people trade their opinions. They see a stock they like. Maybe it's a company with a good product. Maybe it's a sector they believe in. Maybe there's a narrative that makes sense to them. And so they buy. Then they sit there, holding the position, watching it go against them, and they insist they're right. They tell themselves, it's just a matter of time. The market will come around. My analysis is solid. And meanwhile, they're bleeding money. The market is telling them they're wrong, but they're not listening. They're too attached to their opinion. I learned this the hard way, and I learned it more than once because I'm stubborn. I remember being absolutely convinced that a certain railroad stock was undervalued. Everything in my analysis said it should rise. The fundamentals were solid. The company was profitable. The price seemed too low based on everything I knew. So I bought, and I watched it fall. Day after day, it fell. And I held because I was right. Except I wasn't. The market was right. The market is always right, even when it doesn't make sense, even when it seems irrational. My opinion didn't matter. What mattered was price, and price was telling me I was wrong. Here's the rule, and I need you to hear this clearly. Wait for the market to confirm your thesis before you risk capital. If you think a stock is going up, don't buy it when you think it will rise. Buy it when it proves it's rising. Let it break out. Let it show strength. Let the tape confirm what your mind suspects. Only then do you act. This doesn't mean you're late. It means you're safe. And in speculation, being safe and being right are the same thing. Let me give you a concrete example. Say you're looking at a stock that's been consolidating for weeks. It's been bouncing between $40 and $45 back and forth, no real direction. You study the company and you think, this should break higher. The business is strong. The sector is heating up. So what do? The amateur buys immediately. They buy at 42, figuring they're getting a good price before the breakout happens. Then the stock drops to 40. Then it drops to 38. And they're sitting there, frustrated, insisting they're right, insisting it's just a matter of time. The professional does something different. The professional watches. They see the same setup, the same consolidation, the same potential. But they don't act. They wait. They wait until the stock breaks above 45 on increasing volume. They wait until the market shows them that buyers are in control, that the breakout is real. And then, only then, do they buy. Maybe they pay 46 or 47. Maybe they overpay compared to the amateur who bought at 42. But who cares? The amateur is underwater, hoping for a reversal. The professional is in profit from day one because they waited for confirmation. This is what I mean by trading the market, not your opinion. Your opinion is just noise until the market validates it. And the market validates through price. When price breaks out, when volume increases, when the trend becomes undeniable, that's when you know the market agrees with you. That's when you act. Everything before that is just guessing. Now, here's another principle that most people completely misunderstand. Inaction is a position. Let that sink in. Doing nothing is not the same as missing out. Doing nothing is a deliberate choice. It's a position of capital preservation, mental clarity, and strategic patience. When I'm out of the market, I'm not losing money. I'm not being whipsawed by noise and false moves. I'm not second-guessing myself. I'm watching. I'm waiting. And I'm ready. The amateur thinks they have to be in the market all the time because they're afraid of missing the move. They see a stock run and they think, I should have been in that. I missed it. And that fear drives them to jump into the next thing, and the next thing, and the next thing, most of which go nowhere or go against them. The professional is different. The professional is often out of the market because they're waiting for the right move. There's a huge difference between being busy and being effective. The market rewards effectiveness, not effort. I've sat out of the market for months at a time, not because I was scared, not because I didn't have capital, but because nothing met my criteria. Nothing was giving me the signal I needed. And during those months, I watched other traders churn their accounts. I watched them chase false breakouts. I watched them get excited about moves that fizzled out. I watched them exhaust themselves, both financially and mentally. And when the real move finally came, when the trend became undeniable, I was fresh. I was focused. I was fully capitalized. They were broke and tired. This is what patience looks like in practice. It's not passive. It's not lazy. It's predatory. Think of it like a hunter sitting in a tree stand. The hunter doesn't shoot at every sound in the forest. They don't fire their weapon at shadows or rustling leaves. They wait. They stay perfectly still. They conserve their energy and their ammunition. And when the deer finally walks into the clearing, when the shot is clear and the conditions are right, they take it. One shot. Clean. Effective. That's how you make money in the market. The restless hunter, the one who's constantly moving, constantly shooting at anything that moves, they go home empty-handed. They've wasted their ammunition, scared off the game, and exhausted themselves. The market is exactly the same. Most days, there's no clear shot. Most days, The right move is to do nothing. And that's fine. That's more than fine. That's smart. Because when the opportunity does present itself, you're ready to take full advantage of it. Now let's talk about trends, because this is where a lot of people get themselves into trouble. I don't fight the tape. I don't try to catch bottoms or call tops. I don't care about being the first one in or the last one out. I care about one thing: riding the trend while it's in motion. The trend is the market's truth. It's the cumulative judgment of every buyer and seller, every piece of information, every hope and fear playing out in real time. When the trend is up, I'm long. When the trend is down, I'm short or I'm out. I don't get clever. I don't try to outsmart it. I follow it. Most people lose money because they're constantly trying to predict reversals. They see a stock that's been climbing for weeks or months and they think, it's gone too far, it's overextended, it has to come back down. Or they see a stock that's been falling and they think, it's oversold, it's due for a bounce. Maybe, but probably not when you think, and definitely not just because you want it to. The market doesn't care what you think is overextended or oversold. The market will continue doing what it's doing until it decides to stop, and when it stops, it will tell you. Your job is not to predict when that will happen. Your job is to recognize when it has happened. I've made millions of dollars by simply recognizing a trend and staying with it until it ended. I didn't need to know why the trend was happening. I didn't need a story or a narrative or insider information. I just needed to see that it was happening and have the discipline to ride it. And when the trend finally ended, when the market showed me through price action and volume that the character of the move had changed, I got out. No regrets. No hoping it would come back. I just moved on to the next opportunity. The rule here is simple. The trend continues until it doesn't. And when it ends, the market will tell you through clear signals. Your job is to listen, not predict. Most people do the opposite. They ignore the trend and try to predict the reversal. They fight the tape, and the tape always wins. Always. I've seen brilliant men, truly intelligent people with impressive credentials, lose everything because they insisted on fighting a trend they thought was irrational. The market doesn't care if you think it's irrational. The market is what it is, and if you fight it, you will lose. Let me give you a real example from my own experience. Years ago, there was a bull market in steel stocks. Everything was going up. Day after day, week after week, these stocks were climbing. Now, I knew that the fundamentals didn't justify some of those prices. I knew that the stocks were probably overvalued by traditional present measures. But you know what? It didn't matter. The trend was up. Buyers were in control. And I rode that trend for months, accumulating position after position, adding to my winners, letting my profits run. Other traders, smarter traders in some ways, were standing on the sidelines saying, this is crazy. This can't last. These stocks are too expensive. And they were right, eventually. But eventually doesn't pay the bills. I made a fortune during that bull run because I didn't fight it. I recognized it, I respected it, and I rode it. When the trend finally ended, when the market showed me that sellers were taking control, I got out. I didn't hold on hoping for one more rally. I didn't average down when the stock started falling. I took my profits and moved on. And I watched those same smart traders who had been calling the top for months finally get their vindication, but by then, it was too late for them to profit from it. They'd missed the entire move waiting to be right about the reversal. This brings me to another critical point. Emotional trading is expensive. Every single time I've lost money, and I mean every time, it was because I let emotion override discipline. Every time I've made money, real money, it was because I stayed cold. Fear makes you sell too early. You're in a winning position and it pulls back slightly and you panic. You think, I better lock in this profit before it disappears. And you sell, and then you watch the stock continue higher without you. Greed makes you hold too long. You're up big, and you start thinking about how much bigger it could get. You ignore the signals telling you the trend is ending because you want more, and you ride it all the way back down. Hope is even worse. Hope makes you average down on losing positions. You bought a stock at 50 and it's now at 45. Instead of admitting you were wrong and taking the small loss, you buy more at 45, thinking you're getting a bargain. Then it drops to 40, then 35. and now you're in a hole so deep you can't climb out. That's hope destroying you. The market was telling you from the start that you were wrong, but you didn't want to listen. You wanted to be right more than you wanted to make money. And then there's ego. Ego makes you ignore stop losses. Ego makes you refuse to admit mistakes. Ego makes you hold losing positions because you don't want to accept that you were wrong. I've watched men with massive egos lose fortunes because they couldn't separate their self-worth from their trading decisions. They took every loss personally. They saw every wrong trade as a judgment on their intelligence or their abilities. And because of that, they couldn't cut losses quickly. They couldn't adapt. They couldn't learn. The market doesn't care about your feelings. It doesn't care if you're scared, excited, confident, or desperate. It will take your money regardless of your emotional state. The only way to consistently win is to remove yourself from the equation. Trade the plan, not the emotion. If the market hits your stop loss, you're out. No negotiating. No hoping it comes back. No telling yourself. Just one more day to see if it turns around. You're out. Done. If the market confirms your thesis and you enter a position, you stay with it according to your rules. You don't exit early because you're nervous. You don't hold too long because you're greedy. You follow the plan. This sounds simple, and in theory it is. But in practice, it's one of the hardest things you'll ever do. It requires you to act against your instincts. It requires you to accept losses without anger and take profits without excessive pride. It requires you to treat your capital like a tool, not like a scoreboard for your self-worth. Most people can't do this. They're too emotionally invested in every trade, and that's why most people lose. I've watched brilliant men far more educated than I am, lose everything because they couldn't separate their ego from their equity. And I've watched mediocre traders, people with average intelligence and no special insights, survive and thrive because they followed their rules without exception. They checked their ego at the door. They accepted that the market didn't care about their opinions. And they made decisions based on what was happening, not on what they hoped would happen or what they thought should happen. The market rewards the unemotional operator. It always has. It always will. If you can master your emotions, if you can stay cold and disciplined while everyone else is being whipped around by fear and greed, you have an edge. It's not a small edge. It's the edge, because most of your competition is trading emotionally. They're making decisions based on how they feel rather than what they see, and that creates opportunities for you. Now let's talk about position sizing, because this is where a lot of people get tripped up. It doesn't matter how right you are if you're sized wrong. Think about that. You can pick the perfect stock at the perfect time, have the trend completely figured out, and still lose money if you bet too much. I've seen it happen over and over. Traders get so confident in a setup that they go all in. They risk everything on one position. And then the market does something unexpected, something that doesn't fit their analysis, and they're wiped out. The rule I follow is simple. Never risk more than I'm willing to lose on any single position. And when I'm right, I add to the position, but only as the market confirms I'm right. I don't go all in on a hunch. I don't bet the farm on a promising setup. I build into strength. This is called pyramiding, and it's one of the most misunderstood concepts in speculation. Amateurs think you should average down. They think that if you liked a stock at 50, you should love it at 45. So they buy more as it falls, lowering their average cost. This is a catastrophically bad idea. The market is telling you you're wrong. The stock is falling, and you're adding to a losing position. That's not smart capital management. That's ego and hope working together to destroy you. Professionals do the opposite. They average up. They buy more as the stock rises. If you bought at 50 and it goes to 55, and the trend is confirming that buyers are in control, that's when you add to your position. You're not lowering your average cost, you're raising it. But who cares? You're right. The market is proving you're right by moving in your favor. And that's when you increase your exposure, when you have the confirmation, not before. Let me walk you through how this works in practice. Say I've identified a stock that looks like it's starting a new uptrend. It's been consolidating, building a base, and now it's starting to move higher. I don't go all in immediately. I take a small position, maybe 25% of what I'm willing to allocate to this trade. It's a test. I'm seeing if the market agrees with my analysis. If the stock pulls back and hits my stop, I'm out with a small loss. No big deal. I tested the water and the water said no. But if the stock continues higher, if it confirms the trend by making new highs on strong volume, then I add another 25%. And if it keeps going, showing me that the trend is real and strong, I add more. By the time I'm fully invested in the position, the market has already proven to me multiple times that I'm right. I'm not hoping. I'm responding to confirmation. This approach does something psychologically important. It keeps you calm. When you take a small initial position, you're not stressed about it. You can think clearly. You can observe the market objectively. But when you go all in right away, every tick of the stock becomes emotionally charged. Every small pullback feels like a disaster. You can't think straight. You're too invested, both financially and emotionally. Position sizing isn't just about protecting your downside. It's about maintaining the mental clarity you need to trade well. Most people do this backwards. They bet big when they're uncertain and small when they're confident. They take huge positions on unconfirmed setups, hoping to make a killing, and tiny positions on proven trends because they're worried about buying at higher prices. That's a formula for frustration and loss. The disciplined speculator does the opposite. Small positions until confirmation, then larger positions as the market proves the trade is working. That's how you turn a good trade into a fortune. And here's something else about position sizing that people don't talk about enough. It protects you from yourself. When you have a proper position size, when you're not over-leveraged and overexposed, you can actually follow your rules. You can take the stop loss when it's hit. You can hold for the target when the trend is still intact. But when you're sized too big, when you have too much capital at risk, you can't follow your rules. Every decision becomes emotional. You exit too early because you're scared of losing. You hold too long because you need the trade to work. Proper position sizing gives you the freedom to trade your plan instead of trading your fear. Now, I want to talk about something that might sound counterintuitive. Most of the time, the right move is to do nothing. I know I've touched on this already, but I need you to really understand it because it goes against everything you've been taught. You've been taught that successful people are always in action, always making moves, always working. And in most areas of life, that's probably true. But speculation is different. In speculation, most of your profit comes from a small number of trades. The vast majority of your time should be spent waiting for those trades to present themselves. I've looked back over my career, over all the years I've been doing this, and I can tell you that the bulk of my profits came from maybe 10 or 15 really big trades. Not hundreds of trades, not constant activity. A handful of massive, well-timed moves where I went in heavy and rode the trend until it exhausted itself. Everything else, all the other trades, all the activity in between, most of that was just noise. Some small wins, some small losses, a lot of wasted energy. The real money, the wealth that sustained me through decades, came from recognizing the major opportunities and having the patience to wait for them. This is what I mean when I say the secret to making money is knowing when not to make money. You have to be willing to do nothing for long periods of time. You have to be comfortable sitting on the sidelines while other people are active. This is psychologically difficult because it feels like you're not working. It feels like you're being lazy, but you're not. You're waiting, and waiting is work. Waiting is discipline. Waiting is how you preserve capital and mental energy for the moments that actually matter. Think about a professional athlete, a boxer, for instance. The boxer doesn't throw punches constantly throughout the entire fight. They'd exhaust themselves in the first round. No, they wait. They watch. They look for openings. They conserve energy. And when they see the moment, when the opponent drops their guard or gets off balance, that's when they throw the combination with full power. The market is the same. You don't throw punches constantly. You wait for the opening. And when you see it, you commit fully. The problem is that most people can't stand the waiting. They need constant stimulation. They need to feel like they're doing something. And the market is happy to accommodate them. The market will give you plenty of setups that look good enough to trade. But good enough isn't good enough. You need great. You need the setup where everything aligns, where the trend is clear, the volume confirms it, the risk-reward is favorable, and the broader market supports the move. Those setups don't come every day, but when they do, that's when you act decisively. I want to tell you about a period in my career when I had to learn this lesson the hardest way possible. I'd been doing well, making good money, feeling confident, and then I hit a rough patch. I started taking losses. Nothing catastrophic at first, just a series of small losing trades. But instead of stepping back and reassessing, instead of going into cash and waiting for clarity, I kept trading. I thought I could trade my way out of the slump. I thought if I just worked harder, watched the market more closely, took more trades, I'd turn it around. I was wrong. The more I traded, the worse it got. I was overtrading. I was forcing trades that weren't there. I was seeing setups that I wanted to see rather than setups that actually existed. And with each loss, I became more desperate, more determined to make it back. It became a vicious cycle. The losses made me emotional. The emotions made me trade poorly. The poor trades led to more losses. Within a few months, I'd given back a significant portion of my capital. Finally, I had to force myself to stop. I closed all my positions. I stepped away from the market completely, and I spent time just thinking, reviewing my trades, trying to figure out what had gone wrong. And you know what I realized? I'd broken my own rules. I'd stopped waiting for confirmation. I'd started trading my opinions instead of trading the market. I'd let my need to be active override my discipline to be patient. The market hadn't changed. I'd changed. And I'd changed in ways that made me vulnerable. So I made a commitment. I committed to only trading setups that met all my criteria. No exceptions. No close enough. No, this one looks pretty good. Either the setup was there or it wasn't. And if it wasn't, I'd do nothing. I'd wait. I spent the next 2 months mostly out of the market. I watched. I studied. I let opportunities pass by because they didn't meet my rules. It was torture. I'd see a stock make a move and think, I could have been in that. But I stuck to my commitment. And then, finally, the perfect setup appeared. Everything aligned. The trend was clear. The volume was there. The broader market was supportive. It was exactly what I'd been waiting for. And I went in heavy. Not reckless, but with significant capital, sized appropriately but aggressively. And that one trade after 2 months of patience, made me more money than the previous 6 months of constant activity. It was a reminder, a powerful reminder, that less is more in this business. One great trade beats 100 mediocre ones. That experience changed how I approached the market going forward. I became much more selective. I became comfortable with inactivity. I stopped feeling like I was missing out when I wasn't trading. Because I realized that I wasn't missing out, I was waiting for my pitch. And when my pitch came, I'd swing for the fences. Now, let me talk about how you can actually implement this in your own trading. Because understanding a principle intellectually is one thing. Actually applying it consistently is something else entirely. The first thing you need to do is define your criteria before you look at the market. This is crucial. You can't make good decisions about what to trade if you're making those decisions while staring at charts and prices. Your emotions will get involved. You'll see things you want to see. So before you open your trading platform, sit down and write out exactly what you're looking for. What does a valid setup look like for you? For me, it's always been about trend confirmation. I don't trade unless the stock is making higher highs and higher lows if I'm going long, or lower lows and lower highs if I'm shorting. I need to see volume increasing on moves in the direction of the trend. And I need the broader market to support the move. There's no point fighting the tide. Your criteria might be different. You might use different technical indicators or patterns. That's fine. The point is, you need to have them defined in advance, and you need to write them down. Why write them down? Because when you're looking at the market in real time, when you see a stock making a big move, your brain will try to convince you that it meets your criteria even if it doesn't. Your emotions will override your logic. But if you've written down your rules, if they're clear and specific, you can check the setup against them objectively. Does this setup meet all my criteria? Yes or no? Not sort of, or close enough. Yes or no? The second thing you need to do is practice doing nothing. I know this sounds strange, but it's essential. Most people have no experience with deliberate inactivity. They've never trained themselves to watch the market without participating in it. So set aside time, maybe an hour a day to start, where you watch the market but don't trade. Just observe, Watch how prices move. Watch how trends develop. Watch how false breakouts trap amateurs. Watch how real breakouts develop momentum. Get comfortable with the feeling of watching opportunity pass by. Because here's the thing. Most of what looks like opportunity isn't. Most setups fail. Most breakouts are false. Most trends fizzle out quickly. If you train yourself to observe without acting, you'll start to see the difference between the setups that look good and the setups that actually are good. You'll develop pattern recognition. You'll start to feel when something is real versus when it's just noise. But you can't develop that skill if you're always trading. You need time to observe without the pressure of having capital at risk. The third thing, and this is critical, is to keep a trading journal, but not the kind of journal most people keep. Most trading journals are just a record of entries and exits, profit and loss. That's useful for tracking performance, sure, but it doesn't help. You improve. What you need is a journal that tracks your psychology. After every trade, win or lose, write down why you entered, why you exited, and most importantly, how you felt. Not what you think you should have felt, what you actually felt. Were you nervous when you entered? Were you excited? Were you following your plan or improvising? When you exited, was it because your rules told you to, or because you got scared, or because you got greedy and wanted more? Be brutally honest. This journal is for you and you alone. No one else needs to see it. The point is to identify your patterns. Over time, you'll start to see recurring themes. You'll notice that you lose money when you're impatient, or that you exit too early when you're scared, or that you hold too long when you're greedy. These patterns are your weaknesses. The market isn't your enemy. Your habits are, and the journal reveals them. Once you see the pattern clearly, once you can recognize it in real time, you can interrupt it. You can catch yourself being impatient and choose to wait. You can catch yourself being scared and choose to stick with your plan. That's growth. That's how you evolve from being controlled by your emotions to being in control of them. The fourth thing, set hard stop losses and honor them. This is non-negotiable. Before you enter any trade, decide where you're wrong. At what price does this setup invalidate itself? That's your stop. And if the market hits that price, you're out. No exceptions. No negotiations with yourself. No, let me give it one more day. You're out. Done. The stop loss isn't a suggestion. It's a contract with yourself. It protects you from hope, from ego, from the delusion that a losing position will magically turn around if you just hold on long enough. The market doesn't care about your cost basis. It doesn't care that you're underwater. It doesn't care that you can't afford to take the loss. It will take everything you give it. The stop loss is your line, in the sand. It's what separates calculated risk from reckless hope. And respecting it is what separates professionals from amateurs. I've known men who refuse to take small losses and watch them become catastrophic ones. I've watched accounts go from being down 5% on a trade to being down 50% because the trader wouldn't accept being wrong. They kept holding, kept hoping, kept averaging down, and the market kept moving against them. It's one of the most painful things to watch because it's so avoidable. Just take the loss. Accept that this trade didn't work. Move on to the next opportunity. But ego gets in the way. Pride gets in the way. And it destroys people. The fifth thing, and this ties back to what I said about position sizing, only add to winning positions. Never add to losing positions. This is pyramid building, and it's how you maximize a correct trade. When you enter a position and it moves in your favor, the market is confirming you're right. That's when you can carefully, incrementally add more size. You're building your position as the market proves your thesis. But never, ever add to a losing position. That's not dollar cost averaging or getting a better price. That's throwing good money after bad. The market is telling you you're wrong. You bought at 50 and it's at 45. That's the market saying, you were wrong to buy at 50. Why would you compound that mistake by buying more at 45? If the market is going against you, get out. Take the loss. Reassess. Wait for the next setup. Don't dig the hole deeper by adding to a losing trade. When you're right, when the market is confirming your trade by moving in your favor, that's when you increase your exposure. Carefully, with defined stops at each level, but you build into strength. This is how you turn a good trade into a great one. You start small, get confirmation, add more, get more confirmation, add more. By the time you're fully invested, you've been proven right multiple times. You're not hoping, you're executing based on evidence. Now, I want to address something that I know bothers a lot of people. They hear about waiting for confirmation, about not trying to catch bottoms or pick tops, and they think, but doesn't that mean I'm always entering late? Doesn't that mean I'm missing the best part of the move? And the answer is yes and no. Yes, you're not getting the absolute bottom or the absolute top. Those are impossible to catch consistently anyway, and trying to catch them is a fool's errand. But no, you're not missing the best part of the move. You're missing the uncertain part. You're missing the part where no one knows if the move is real or not. Think about it this way. A stock has been in a downtrend. It hits a low and bounces. Is that the bottom? Maybe. Or maybe it's just a brief rally in an ongoing downtrend. You don't know. No one knows. The amateur tries to catch that bottom. They buy at what they think is the low, hoping they're right. And sometimes they get lucky. But most of the time, the stock bounces briefly and then continues lower, and they're stuck holding a losing position. The professional waits. They watch the stock bounce. They watch it rally. They watch it form a higher low. They watch it break above previous resistance. They watch volume increase on the upside moves. And then, when the trend has clearly reversed, when the market has shown that buyers are in control, that's when they buy. Yes, they paid more than the absolute bottom, but they bought with confirmation. They bought with evidence. They bought when the probabilities were in their favor. And here's the key. They're sleeping well at night. They're not stressed. They're not hoping the stock turns around. They're in profit from the start because they waited for the right entry. The amateur who tried to catch the bottom, they're underwater, stressed, hoping and praying. Even if both traders eventually make money on the move, who had the better experience? Who was trading from a position of strength versus a position of hope? This is what I mean when I say that waiting for confirmation doesn't mean you're late. It means you're smart. It means you're trading with the odds in your favor instead of against them. And over time, over hundreds of trades, that edge compounds. It's the difference between a profitable career and a series of stressful, break-even experiences. Let me also talk about something that's becoming increasingly important: the noise. There's so much noise now. So much information, so many opinions, so many talking heads telling you what they think is going to happen. News comes out every second. Social media is filled with people bragging about their trades or panicking about their losses. It's overwhelming, and most of it is completely useless. Here's what you need to understand. The market will tell you everything you need to know. You don't need anyone's opinion. You don't need to know what some analyst thinks or what some guru predicts. You need to watch the price. Price tells you what's happening. Volume tells you how strong the move is. The trend tells you which direction the market wants to go. Everything else is just noise. I built my entire career in an era before social media, before 24-hour financial news, before everyone with a phone could broadcast their opinions to the world. And I'm grateful for that, because I had to learn to read the market itself. I had to learn to trust the tape, to watch the price, to feel the momentum. That skill is even more valuable now because so few people have it. Everyone's too busy listening to noise. So here's my advice. Turn off the noise. Stop reading the predictions. Stop watching the talking heads. Stop following the social media traders who post screenshots of their wins but never mention their losses. None of that matters. What matters is what the market is actually doing. Can you see the trend? Can you see the volume? Can you see the confirmation? If yes, you have everything you need. If no, then wait. This is harder than it sounds because humans are social creatures. We want to know what others think. We want validation. We want to feel like we're part of something. But trading isn't a social activity. Trading is you versus the market. And the more you let other people's opinions into your head, the harder it becomes to think clearly. I made my biggest fortunes when I was completely isolated from the opinions of others, when I was just watching the tape, following my rules, trusting my process. The times I got into trouble were often when I started listening to others, when I let their confidence or their fear influence my decisions. The market doesn't care what anyone thinks. It only cares what is. and your job is to observe what is, not what people say should be. Now, I want to talk about something that might be uncomfortable but needs to be said. Most people will not succeed at this, not because they're not smart enough or not educated enough, but because they can't master themselves. They can't sit still. They can't control their emotions. They can't follow rules consistently. And that's okay. This business isn't for everyone. But if you're still listening, if you've made it this far, then maybe you're one of the few who can do it. The difference between success and failure in speculation isn't about finding the perfect strategy or having access to special information. It's about discipline. It's about doing the boring, unglamorous work of following your rules day after day, trade after trade, even when it's not exciting. It's about taking losses without getting emotional. It's about letting winners run even when you're nervous. It's about sitting in cash for weeks when there's nothing to trade, even though it feels like you're wasting time. This is hard work. Not physically hard, mentally hard, emotionally hard. Most people would rather have a complicated strategy they can tinker with than a simple set of rules they have to follow consistently. Because tinkering feels productive, following rules feels boring. But boring is what makes money. Excitement is what loses it. I've often said that the most important lesson in speculation is learning to sit quietly, to do nothing, to wait. Because if you can master that, if you can truly master the art of patience, then the rest becomes easy. The entries become obvious. The exits become clear. The position sizing becomes natural. But it all starts with patience. It all starts with being willing to watch the game from the sidelines until you get the signal to step onto the field. Think about what I'm asking you to do. I'm asking you to go against every instinct you have. I'm asking you to be patient when your brain is screaming at you to act. I'm asking you to do nothing when everyone around you is busy. I'm asking you to wait for confirmation when you think you already know what's going to happen. I'm asking you to take small losses quickly when your ego wants to prove you're right. I'm asking you to let winners run when your fear wants to lock in profit. None of this is natural. All of it is necessary. The market is a game of probabilities. You can't win every trade. You won't win every trade. But you don't need to. You need to win enough of your trades, and you need to win big on the ones you get right. That's the formula. Small losses, big wins. How do you get small losses? By cutting them quickly when you're wrong. How do you get big wins? By letting them run when you're right. And how do you know when you're right? By waiting for the market to confirm it. Everything I've told you today comes back to one central idea. Let the market tell you what to do. Don't impose your will on the market. Don't trade your opinions or your hopes or your fears. Trade what the market shows you. Wait for the signal. Act on confirmation. Manage your risk. Let your winners run. Cut your losers short. Be patient. Be disciplined. Be cold. This is the rule. This is the only rule that matters. And it works in bull markets because you're buying strength, not hope. It works in bear markets because you're shorting weakness, not trying to catch falling knives. It works in sideways markets because you're not trading at all, you're waiting for clarity. The market hasn't changed. The principles haven't changed. Human nature hasn't changed. And the laws of speculation never will. You might be thinking, but what about all the other stuff? What about technical indicators? What about fundamental analysis? What about sector rotation and economic data and all the complex things that people talk about? And my answer is, those things can have value if you understand them, but none of them matter if you don't first master this basic principle. None of them will save you if you're trading emotionally, if you're overtrading, if you're fighting the trend, if you're refusing to take losses. The foundation has to be solid, and the foundation is discipline, patience, and letting the market confirm your ideas before you risk capital. I've spent my entire life in this business. I've made millions. I've lost millions. I've done it all multiple times. And every time I've succeeded, it was because I followed the principles I'm sharing with you today. Every time I've failed, it was because I broke them. It's that simple. This isn't theory. This isn't something I read in a book. This is what I've learned through decades of real experience, through real money won and lost. And I can tell you without hesitation that if you internalize what I've told you today, if you really commit to following these principles, you'll have an edge in the market, not a guaranteed win. There are no guarantees. but an edge. And over time, over hundreds of trades, that edge compounds. It turns into consistent profitability. It turns into wealth, but only if you do the work, only if you master yourself. The market will always give you opportunities to lose money. It will tempt you with setups that look good but aren't. It will test your patience by making you wait. It will test your discipline by moving against you temporarily, even when you're ultimately right. It will test your courage by requiring you to act when you're scared and to wait when you're excited. These tests never end. Every day you trade, you're being tested, and the market is a harsh teacher. It will take your money if you fail the test. But if you pass, if you consistently apply these principles, the rewards are substantial. So here's what I want you to take away from this. The secret to making money in the market isn't about constant activity. It's about strategic inaction followed by decisive action. It's about watching and waiting until the market shows you, clearly and unambiguously, what it's doing, and then committing with full conviction when that moment arrives. It's about cutting losses quickly when you're wrong and letting profits run when you're right. It's about managing your position size so you can think clearly and trade your plan instead of your emotions. This is the rule I've followed for my entire career. It's the rule that's made me wealthy when others went broke. It's the rule that's kept me in the game through crashes and manias and everything in between. And it's the rule that will work for you if you commit to it. Not sometimes, not when it's convenient. Every single time, without exception. You're not broken. You're not unlucky. You haven't been cursed by the market. You've just been taught wrong. You've been taught that success requires constant action, constant hustle, constant engagement. But in speculation, that's a recipe for failure. In speculation, success requires patience, discipline, and the wisdom to know when to do nothing. I've given you the truth today. I've shared what took me decades and fortunes to learn. The question now is, what will you do with it? Will you go back to trading the same way you've been trading, hoping for different results? Or will you commit to changing? Will you commit to waiting for confirmation? Will you commit to cutting losses quickly? Will you commit to letting winners run? Will you commit to being patient, even when it feels like you're missing out? The choice is yours. The market doesn't care what you choose. It will keep moving, keep creating opportunities, keep taking money from the undisciplined and giving it to the patient. The only question is, which side will you be on? If what I've shared today resonated with you, if something clicked, if you felt a shift in how you see trading in the market, I want to hear about it. Leave a comment below. Tell me what stood out. Tell me what you're going to do differently. Tell me about your own experiences with patience and discipline, or about the times you broke your rules and paid the price. This conversation doesn't have to end here. We're all in this game together, learning the same hard lessons. And if you want more of this, if you want more truth about speculation and discipline and what actually works, subscribe to this channel. I'm going to keep cutting through the noise. I'm going to keep sharing the principles that have stood the test of time. I'm going to keep speaking the truths that the financial industry doesn't want you to hear because they profit from your activity, not your success. The market hasn't changed since I started trading. Human nature hasn't changed. The principles of successful speculation haven't changed, and they won't change in the future. What I've shared with you today will work as well 50 years from now as it worked 50 years ago, because it's based on how markets actually function, on how prices actually move, on how human psychology actually operates. You now have everything you need. You have the knowledge, you have the principle. What you need to develop is the discipline to apply it consistently. And that's where most people fail. Not because they don't know what to do, but because they can't make themselves do it. They can't sit still when their instincts scream at them to move. They can't wait when everyone around them is active. They can't take losses when their ego wants to be right. But you can. You can because you've made it this far. You can because something in you knows that what I've said is true. You can because you're willing to do the hard work of mastering yourself, which is infinitely harder than mastering any strategy or indicator or system. So here's my final challenge to you. Stop trading your opinions. Stop chasing. Stop hoping. Start watching. Start waiting. Start acting only when the market tells you it's time. Give yourself permission to do nothing when nothing is the right move. And when the moment arrives, when the market gives you that clear signal, act with full conviction and without hesitation. This is how you survive. This is how you profit. This is how you win in a game that destroys most people who play it. The market will teach you if you let it. But you have to be patient enough to listen. You have to be disciplined enough to follow what it tells you. And you have to be courageous enough to act when the moment is right, even if you're scared, even if you're uncertain, even if everyone else thinks you're crazy. The path to wealth in this business is narrow. It's not complicated, but it's narrow. Most people can't walk it because it requires too much self-control. But for those who can, for those who master patience and discipline and emotional control, the rewards are extraordinary. Not just financial rewards, though those come, but the satisfaction of knowing that you've mastered one of the hardest games there is. The satisfaction of knowing that you can trust yourself, that you can follow your rules, that you're not controlled by fear or greed or hope or ego. That's what I'm offering you. Not a get-rich-quick scheme, not a hot stock tip, not a magic indicator. I'm offering you a way of thinking about the market and about yourself that, if you commit to it, will change everything. It will make you a better trader. It will make you a better decision maker. It will teach you patience and discipline that will serve you in every area of your life. But it starts with one decision: the decision to stop fighting the market and start listening to it. The decision to stop trading constantly and start waiting strategically. The decision to be patient when patience is hard and to be courageous when courage is hard. Make that decision. Commit to it. And watch what happens. The market is waiting. The opportunities are there. They always have been. They always will be. The question is, will you be ready when they arrive? Will you recognize them? Will you have the patience to wait for them and the discipline to act on them? That's entirely up to you. Now go. Wait. Watch. And when the time comes, when the market shows you that clear signal, when everything aligns, act. Act with conviction. Act with discipline. Act like the professional you're becoming. And remember, the secret to making money isn't about how much you trade. It's about how well you trade. And trading well means knowing when not to trade at all. Thank you for listening. Thank you for being willing to hear hard truths instead of comfortable lies. And thank you for taking this journey with me. I hope what I've shared serves you well. I hope it changes how you see the market. And I hope most of all that it helps you become the disciplined, patient, successful trader you're capable of being.